Hey there. Today, I want to share a little bit about economic trends going on in the marketplace. More importantly, where mortgage rates are going to go by the end of 2022 and into 2023. And even more importantly, are we going to have a recession? That's obviously the talk on the media right now. There's a lot of misinformation going on. So, I'm going to show you some actual facts, actual data from people that study this stuff all day and all night that actually specialize in studying mortgage rates. Unfortunately, a lot of the media pundits and media talking heads don't really know a lot about actually what causes mortgage rates to go up and down. And there's just so much misinformation. I'll make sure that you have the most accurate and current information possible. Now, I don't do this alone. I don't make up these numbers. I'm actually subscribed to Barry Habib's MBS Highway. And so some of this data I'm sharing is stuff he shared with me. And so I spent quite a bit of money to learn this stuff, but sharing with you right now for free. So give me a quick second to pop open a couple things. We will take a look. Get the screen to load. And here we go. So rates, real estate, and recession. So what are the dynamics? So the first one is inflation. Obviously inflation's been a big talk of the year, been really frustrating. It's in the news. It's real. I'm not going to get into the politics of what's causing it because obviously some people get more upset than others about what's causing it, but we know the base causes of it. The Fed has announced some hikes, and they are doing what's called a balance sheet runoff. Now, the balance sheet is what they're doing with mortgage-backed securities. So, did you know that the mortgages, they're actually securitized? So, for example, when you get a mortgage, it's bundled with all the other mortgages that are originated that month and becomes what's called a mortgage-backed security. And then that's put out in the bond market, and then institutional investors, like your mutual funds, will go ahead and buy those because they are considered safe investments. Now, the Fed can actually buy and sell mortgage bonds as well. And when they are purchasing more, there is a term for that. And then when they sell those, it's called a runoff. And this also affects recessions. So I'm going to go through a little bit about what's going on in that bond market. So we're going to start in the late 70s, early 80s. There was a guy named Mr. Burns who handed the Fed chair off to Mr. Volcker. And so in the mid 70s, inflation was at 7%, ended up going up to 14%, kind of scary. Mortgage rates got higher because as inflation went up, the mortgage rates had to keep up because those bondholders were losing money. When you have 14% inflation, bondholders are like, wait a minute, we need a little extra money here to keep up with that inflation. And so mortgage rates actually went up as high as 18% in the late 70s, early 80s, believe it or not, kind of scary. So what happened was Mr. Volcker started hiking what's called the Fed funds rate. And when you hear about the Fed hiking rates, it's actually the Fed funds rate that's been going up. And so they raised that from 12% to 18%. I'm sorry, from 11% to 20% to stop that inflation in the early 80s. And sure enough, it did work. Inflation actually went down from 14 down to 5% in the 80s. And then that in turn caused mortgages to drop from 18% down to 12%. But the consequence of that was the stock market went down. There was a recession. Now, Mr. Greenspan, who was the chair in the mid 80s, inflation when he started was 1.75, started creeping up to 3.5. Mortgage rates when he was Fed chair started at 7, went to 8.5. So he hiked the Fed funds rate from 4.75 to 6.5. And sure enough, that did actually drop inflation down to 1% at the end of his chairmanship. And sure enough, that dropped mortgages from 8.5 down to 5.5 and caused a really nice refi boom there in the late 80s. But the downside of that was the S&P 500 went down 50% and there was a recession. So now I got current period, Mr. Powell. So we started at 1.5 when he became chairman. Due to all the factors in the market right now, it's now at 8.5, the last report. Mortgage rates started at 2.5. Now we're in the 5s. And the Fed funds rate has been going up. It started at 0 at the beginning of his chairmanship. We're at 0.5% now. We're expected to go up to 3% by the end of this year. Now, inflation should drop at some point. The question is, we don't know when. Obviously, there's the economy heating up. We got all these overseas factors like Russia and China. But at some point, inflation should drop. And as that inflation drops, the mortgage rates should decline at that point. The problem is that as inflation still lingers, the rates are going to go up in the short term. Now, as that happens, the economy is going to slow down. Stocks are going to go down. At some point, we're going to have a recession soon as well. Now, let's look at the Fed hikes, the impact on rates, because people are thinking, oh, the Fed's hiked rates are going to go up. It's actually the opposite. As the Fed hikes rates actually start dropping. And so as we can see, starting in 2016, they raised rates 25 basis points, and there was a drop in mortgage rates right there. Again, in late 2016, early 2017, 25 basis point hike, rates drop, 25 basis point hike, rates drop. Then the Fed did a runoff, which actually did raise the rates. So they were pulling back on their security purchases. And then there was another Fed hike, caused a small drop in rates, another Fed hike, drop in rates. And then the hikes finally took hold at the end of 2018. Rates really started dropping. They slowed down the runoffs at the end of 2019, and then rates really went down in 2020 going into 2021. So as you can see that the Fed's actions do have an effect on mortgage rates, but they're not what people think they are. So inversions do lead to recessions, and inversions are a pre-recessionary indicator. And so an inversion is the 10-year yield versus the 2-year yield on treasury bonds. Typically, the 10-year gets a higher yield because it's a longer term than the 2-year. But in certain periods, the 2-year actually pays more than the 10. And that's called an inversion. When there are inversions going on in the bond market, 99.9% of the time that does lead to a recession. It's a pre-recessionary indicator. And so as we can see right here at the end of April 2022, there was a inversion. And if you look back at history, starting in 1980, all the spots in red were inversions, and then the recession. These barred areas, those are recessionary periods. So in the 80s, there's a big inversion, recession. Mid 80s, another inversion, another recession. Early 90s, another inversion, another recession. Early 2000s, inversion, recession, et cetera, et cetera. The unemployment rate is also an indicator of recessions, and it's not exactly what people think it is. It's actually when unemployment hits a bottom and starts to creep back up. It's a recessionary thing, and that's kind of where we're at right now. So all the way back to 1950. So, right there, early 50s, it kind of dipped down. Sure enough, as soon as it started going up, recession. Mid 50s, dip down, start going up, recession, et cetera, all the way through the chart. Dip down, recession, dip down, recession, dip down, recession. And so that's what we're seeing right now. We're almost at the bottom. Unemployment's starting to creep back up. And then as soon as it starts creeping back up, it becomes a recession, because as people start losing their jobs, they spend less money. It kind of becomes a cycle where they lose the job. Of course, they spend less money. And then that as they spend less money, then who they're buying from start lose money. They start laying people off, and it kind of cascades into a recession. That's what's happening there. And so mortgage rates, what about mortgage rates in recession? So interestingly, recessions are actually good for mortgage rates. Obviously, it's bad for the rest of the economy, but on the mortgage side, it's actually good for mortgage rates. And so as we can see, mid-80s, recession drop. Again, mid-80s, another recession, another drop. Late 2000s, recession drops. All these periods in yellow, there was a recession and then drop in rates. So here are some of the drops. So some of these are pretty significant, from 18 to 13, 16 to 11, from 375 to 275. So yeah, some of these drops have been pretty significant when these recessions hit. But what about housing? You got to be saying, well, didn't recession crash the housing market? And actually it didn't. As you can see, mid-70s, mid-80s, mid-90s, recession. Housing kept going up and up and up. Now you might be saying, well, what about 2008? What about that period? And I think that's a valid concern. Very valid question. And sure enough, it did drop during that period. But remember, that period was a period where it's a bit of an anomaly, because during that period, we actually had a period where lenders were being very, very generous with their handing out of mortgage applications, mortgage approvals, I should say. And it got to the point where if you could fog a marriage, get a loan, and way too many crazy loans being done in that period. And so, of course, if you have a period where too many loans are being made to people that shouldn't get a loan, guess what? That's going to cause foreclosures and cause a housing crash. And that's exactly what happened in the 2008. Not anywhere near what's happening right now. We still very much look at everything involved, and definitely not. We don't give a loan to just anybody, in other words, these days. And also, here's the other big key you have to understand between 2008 and now. We actually had an inventory peak of 3.7 million homes on the market in late 2007. There are a lot of homes on the market and not nearly as many buyers. And so, of course, too many sellers, too few buyers, of course, it's going to crash the market. Right now, it's the total opposite, because there's just not enough homes being built. It's been a problem for years. Meanwhile, there's more millennials coming in the market because of birth rates from the late 80s. And so right now, we've got too few homes and too many people buying, honestly. So right now, we got 870,000 homes in inventory, which is very, very low. And households have gone up. So 2007, there were 116 million households. 2021, 129 million households. And because of the way birth rates are, there are more and more people hitting that peak buying age of 32, 33 years old, because they're born in the late 80s due to that millennial generation. And so it actually keeps going up and up and up and higher and higher. Meanwhile, we have record low inventory. So we don't see housing going down at all. I mean, it's just not there. So that's the end of the slideshow. I hope you enjoyed that. As always, if you have any questions, feel free to give me a call. One of these days, I'll actually figure out how to use this thing. Hold on here. There we go. Oh my gosh. Feel free to give me a call. My number is 937-572-3713. You can also reach me at scarpero.com. Later. Thanks.